While the market is down by close to 18% from the top it saw, do you know that the earnings multiple, which is popularly measured using something called PE, is down by close to 50% from the top it saw last year? Now you may think, why is this so important? Watch this complete video for more. Like always, first we should know the number in detail before we understand the impact of that on our portfolio. What is PE? P stands for price, which is nothing but the market levels, and E stands for earnings. Let's say you want to measure the PE, price earning multiple of Nifty. All you need to do is divide the price of Nifty by the earnings of all the 50 stocks put together. That's how you get the number of PE for Nifty 50. This can be done for individual stocks. This can be done for other indexes also. In general, the lower the PE is good for the index. Again, this is just a general concept and nothing specific to a certain stock. There are many stocks whose PE are lower than 2, and there are hundreds of other stocks whose PE are running at over 50. So there is no certain number to say that PE should be at these levels. But in general, a good company available at lower PE is good news for us. Now, India is a country which is growing at a fast pace, and therefore many investors in general are ready to pay higher PE. That's what we saw in the year 2021. While the world was struggling with the pandemic, India started showing great signs of growth. And that's the reason why a lot of investors started flocking India, including domestic and foreign, therefore pushing the PE number higher and higher and higher. This was an expectation that the earnings number also will catch up. But if the price keeps shooting without the earnings shooting much, then your PE starts looking very high because your earnings are the same or slowly growing while your price is growing faster. This led to PE being close to 40 for Nifty 50 stock last year. Okay, so now let's look at the current situation. Nifty from the highs has come down by 18%. So roughly it has seen a fall of about 3,500 odd points. While on the other hand, the PE, which was close to 40, has cracked down to 20 in the recent days. Now you may think, why did this happen? Is India so bad that the earnings have fallen off the roof? Not at all. In fact, India is one of those countries that is growing. People are definitely reducing the growth numbers, but still we are growing or expected to grow at about 7.8%. Add inflation to it, the nominal GDP becomes in healthy double digits. In general, the expectation is that the EPS, which is nothing but the earnings per share, should grow by about 15% in this coming year too. Let's assume that 15% is not possible. We will still end up growing at about 10, 12 or 13%, which is a very healthy number, believe me, in these times. So just to give you some data, Nifty EPS, earnings per share, was roughly about 740 as of March 2022. Add about 15% growth to it, so we should be about 840 or 850 number the next year. Remember, we are in the new financial year and therefore our futuristic EPS is roughly about 840, 850. Let's assume there is a big impact of Fed and inflation and interest rate hike. Let us reduce it by, let's say, 20 more points, which is 820 or 830 should be our EPS. So typically, if you were to invest today at a PE of about 20, you multiply that by the EPS, which is roughly about 820, you are expected to be at a level of about 16,400. Now just calculate how much is Nifty at currently. It is at 15,500. So clearly we are well below the base price or expected level of about 16,200. That's good news. Now you may think that then if I invest at these levels, the price will not go down. That's a wrong assumption to make. You may think that I'm asking you to invest at these levels with an expectation that Nifty will not go down from here. That again is a wrong expectation. All I'm trying to say is that the base number look pretty attractive at these points in time. Yes, it doesn't guarantee that the Nifty may not fall from here. For all you know, it can go down another 5, 7, 10% also. While on the other hand, I strongly believe that if Nifty falls from here, it will quickly recover back to be at these levels at least for some more time, because PE below 20 is generally attractive for a growth economy like India. Yes, there are times when it has gone down to as low as 12. Yes, in 2008 it went down to as low as 10 and 12 too. But it quickly bounced back to about 17, which was the average at that point in time. Remember, India is in much better position today, both on economic front, both on CAD front, the currency front, and the stable government front. Therefore, you will definitely have higher PE. So my base case is that investing at these levels may be good even if it falls another 10% or so. But if you were to expect great returns from here on, maybe you will go through some bit of a pain before the gains start accumulating to you. Now then you say, tell me in brief, what should I do? All I'm trying to say is that if you have 100 rupees to invest today, try to invest about 15 rupees today and keep adding as the market falls. Don't look at absolute numbers only, saying, okay, I'll invest at 50,000 Sensex or 15,000 Nifty. Just keep adding as it falls and wait for some kind of good news to come through when the valuations will revert back to normal. So in a nutshell, invest about 15% at these current levels. Good luck, happy investing.